Good afternoon. We're going to start. Last week, as you remember, we devoted actually a three-part discussion to risk and insurance. And it started with that talk we had on Wednesday evening between Madame Monica Merkler, who came from Switzerland, where she had been one of the major regulators of the markets, financial markets there, and Monsieur Hugues Pirotte here from Solvay School. The following day we had, that was first my lecture, and then we had a panel discussion between representatives of the insurance sector, either on the regulator side or on the side of the industry as such. And in my talk in particular, I had a general discussion first about the notion of risk. And like the other speakers, we covered the notion of systemic risk, which has become so prominent in the discussions since the beginning of the subprime crisis in 2007, 2008. We were aware before that period that something like contagion could happen on the financial markets, and there's a famous phenomenon of run on the bank, or bank run, which is when the depositors in banks become worried that maybe all their money is not left within the bank, that they come in a crowd and claim their money back. And because the financial sector is in the business of intermediation, that it may have lent money which is on the depositor's account, well, the money is not there as a liquidity, and we have a disaster ensuing. The crisis has shown some of the domino effect of one institution coming down. The other part of the talk was on the insurance business as such, and I covered like a brief history starting in the 17th century when the notion of an annuity was introduced. It had happened. I gave some examples in the ancient times, in antiquity, of things of the type, but it's very much in the, as far as our culture is concerned, very much in the 17th century that the ideas appear, and that therefore an industry develops where you can make calculations about risk, which is present in some activities, in order to develop an industry which has some solid basis. Of course, the calculations need to be rest on some evidence, empirical evidence, how many losses occur over a period due to some incidents or accidents, and also you need a mathematical framework that typically statistical analysis and probability theory provided over the years. Today, what I'm going to talk about is one particular instance, historical instance. The story takes place in 2001, and why take one particular test case or showcase in particular? Because the fall of the company called Enron in the United States shows all the aspects which are involved when we try to determine closer what should be an ethical approach within finance, and what happened in that theory which could make us understand better what would be the notion of stewardship of finance, as opposed to what was displayed in that particular, in the downfall of that corporation, American corporation. It needs to be said that from the beginning that a company which was supposedly ranked number 7 among American companies in terms of its financial, of its equity, of its financial robustness, that its size, that a company was ranked supposedly number 7, fell over a period of 46 days only. 1.5 months. It's extremely short, as you can imagine. The company was regarded at the beginning of these 46 days as being particularly robust. It was shown as an example. It was not only in magazines, but also in the financial literature. It was chosen an example what a company should be. And despite that, it had that extremely fast downfall. So analyzing what happened is particularly illustrative. And just as in the discussion I had 2 weeks ago here about the distribution of wealth, and where I started my lecture by showing how two slightly different approaches to how new wealth is being created in production by just having these two, what looks at first sight as very minor difference in approach, how it leads in the end to a totally different view of what would be an ethical position on a particular issue within finance, showing how delicate, I would say, the mechanism is in terms of a mixture of greed, lack of understanding, structural effects, all elements which are there together, and which complexity, and make it particularly difficult to decide where should you tackle the problem to start with. And I believe that by the end of this particular lecture, just dealing with one particular company over a period of 46 days will show once again how difficult it is to have a picture that would tell us exactly where is it that you need to intervene in order to make things different. There are so many elements which are part of our culture, the way we behave towards things, and our economic culture and our financial culture, which may not be the same, but leading to the same, in reality, being mixed into the same reality. I said already a company that was supposedly ranked number 7. And I said that entirely deliberately because when the analysis began at the beginning of 2002, just after the company had actually filed for bankruptcy, an accountant made an analysis of the financial figures of Enron and showed that according to his calculation, the company was not at all ranked number 7 among American companies, but ranked 287. And the difference between the two figures he traced to the way that derivative instruments were accounted for within the quarterly and annual, yearly balance of the company. I will say more about financial derivatives. I don't remember if it's the coming session or the coming lecture or the following one, but I will go there specifically into that. But as you know about a derivative is a financial product, the value of which is derivative, is derived from that of another financial instrument, which is called the underlying, the actual basis of what the derivative. I'll just give you one example, a very simple one and a very early one. There was something that existed in the United States in the beginning of the 20th century, which was called the bucket shops. And in the bucket shops, bucket shops were like places where you can go bet on horse races. It had nothing to do with the stock exchange, but in the bucket shop you could make wagers, you could bet on the way that the prices will go at within the stock exchange. There was no communication. The two businesses were entirely different. It was not properly a financial derivative instrument, but money was lost and gained by the bettors on the evolution, the way that the prices were developing in the stock exchange. In that case, the underlying was the value of the stocks on the stock exchange, which had a legal organization. And in a bucket shop, you would be simply betting on the on the way that the value of these shares would go up or down. I think in an example like that, you have a clear view of what is the underlying, which is something that works really in the economy, and the derivative, which is some kind of bet, actually, on the operation of something else. I'll go back to that notion because, to some extent, it may be central on some of the things I'll say about Enron. The reason that difference between the number 7 and 207 is because when you make bets, the bets may be on differences rather than on the things that you're betting on, essentially. I'll give you an example, a more sophisticated derivative instrument, which is called an interest rate swap. Typically, in an interest rate swap, you will have two parties, and the two parties will be exchanging cash flows at a particular time, and usually on a swap, there's a periodicity. Every 6 months, you will make that exchange of flows. And what in an interest rate swap, what you have is the following: you have one party will pay interest on a particular amount of money that will be a fixed interest. It will have been defined beforehand, before the contract starts, like 5.3%. The other party will pay a cash flow also on the same, calculated on the same amount of money that will be defined by a particular market rate, a fluctuating market rate determined by the market itself. The people are prepared to lend money, and people are prepared to borrow. What is the particular interest rate that they agree upon, and that fluctuates within financial markets according to the state of the economy that will allow to pay less or pay more, the power balance between borrowers and lenders, and so on. And how is the fixed rate determined at the very beginning of the period when they decide to have that swap? The fixed rate will be, on the day of the conclusion of the contract, the market rate. So let's say that they decide to start a swap, and that the benchmark, the basis for the calculation, is the 3 months LIBOR. On the day the swap is initiated, if you look up the market rate for the 3 months LIBOR, it's 3.5, and that will be the set rate for the swap. Because the fixed rate and the fluctuating rate, the market rate, on the day we start, there's no actual exchange of cash flows, because they would be the same amount, and so they cancel out, they consolidate, and therefore there's no exchange on the first day. But then, say 6 months later, there will have been a fluctuation in the market. It's very unlikely that the market rate for LIBOR 3 months will be 5.3 6 months later. It might be 5.4. And in that case, one will pay 5.3, the other one will pay 5.4. So what they will be paying is the difference between the two rates. I mean, the actual flow that will take place is the difference between the two. They could actually exchange 5.3 to 5.4, but it would cancel out for the 5.3 part. And therefore, in practice, you will only pay the 10, a tenth of a percentage in the exchange. So you see, in that example, let's say the calculation is on $1 million. Okay. One will pay 5.3, and the other one will pay 5.4. Now, I have to make the calculation properly. I'm talking there in percentages, percent. So 1 million, it will be 110,000. 10,000 divided by 10. If my calculation is right, one will pay $1,000 to the other. There's someone who agrees with me, so the calculation is probably right. But you see, what is called the notional amount is the amount on which you make the calculation, which is $1 million. You calculate as if you were dealing with a $1 million loan, but the flow that will take place on that first, after 6 months, will be only $1,000. If you make calculation for the balance of the company on $1,000, which is the actual, let's say, kind of risk on which one party was actually, turns out that one of the party was actually exposed only to the $1,000 exposure, because that's what they had to pay. If you use the $1,000 in your calculation for your quarterly balance, that's one thing. But if you use the $1 million in the calculations, it will be a very different issue. Now, what had Enron done? It had, in its quarterly and yearly figures released, used the notional amount. It used the $1 million amount. And it was on that basis that the calculation was made. It should have done on the $1,000 or on whatever figure was on at that time. And it is that person who was that accountant who said after the fall of the company, well, actually, if it was ranked number 7, while it was on using the $1 million figure, and if you had done it on the $1,000 figure, then you would have ranked it 287, which was actually the actual value. I mean, the corresponding to real value of the company. Why is it possible? The question you ask yourself is, why is it possible that Enron make the calculations on the $1 million instead of the 1,000, and that nobody objected to that for a while? Well, I think that's is one of the symptoms of what was the issue around the Enron company. This was displaying an attitude which is, we can actually afford to do whatever we want, and nobody will object to what we're doing. And that was very much part of the climate of affairs in that particular period, because as you may remember, when I say 2001, in that period of the fall of Enron, we were just after the collapse of the dot-com bubble on the stock exchange. We were just, if you look at the way that the value of the stock, of the share of Enron was going up, and was going in a period which led to, let's say, the end of 2000. You see, you take a kind of average, an index for the dot-com industry, and you would see that value going up, ramping up. And you could see, if you put Enron, you would see exact same thing was going in parallel. Then at the end of 2000, collapse of the dot-com. And then you see, at that point, you see Enron was going on. To some extent, Enron was a survivor of the dot-com bubble. It was very much, and I'll return to that, to some extent, it was a dot-com company. Dot-com meaning related to the development of the internet. And as you may know, the development of the internet was very much a phenomenon which was due to the impossibility we were in to assess properly what would be the impact on society of the development of the internet. There was a view that it was changing the world, but there was no way we were properly assessing in what way it did. And if you look at Enron not as a culprit, but as a company that may have been a victim of that process just along as any other, there is an element for that. And part of the reason why the company became extremely fragile, you will realize that it had invested a lot of money in what is called broadband, which is the capacity to have communication from the internet going through cables. The cables might be optic fiber or whatever cable, but Enron invested a lot in that business, put a lot of money in it, and there was by much overcapacity. The internet was not ready yet to use that capacity. It would now. It would be a possibility that they were in that dimension, they were just ahead of their time. They had miscalculated how much the internet would impact the change in business, but in that way they were not any different from all the companies that fell. We know the survivors. We know about Google, we know about Microsoft, we know about Yahoo, we know about Amazon. A number of companies have managed to work through that. Some have not. Some have not. I'll mention a personal anecdote, but which I think is revealing about the climate of that year 2000 and the year 2001, which was an interview I had in Southern California, a job interview, and I had apparently the profile that that company needed at that time. And I think it's relevant that I don't remember what the company intended to do, because for a lot of these dot-com companies, their business plan was kind of fuzzy. We're going to do something really marvelous about the internet, but sometimes there was no real flesh to what was being said. And you may know, but at the end of these interviews, you've been asked a number of questions. At the end of the interview, people turn to you and say, have you any questions to ask us about the company? And I said, yes. I remember I said, well, it looks like there will be a transition. There'll be a time where something will be very, very different. And can you say a bit more? Because I seem to see that. He said, well, I mean, the man says he was very, very honest. He was straightforward. And he said, well, the fact is, yes, I mean, you will be part of the company in its new appearance, in its new image. And me, my colleagues, all the people who start a company, we will retire. And that was it. I mean, that was a business plan. They were building that hype about what would happen and when there would be initial IPO, initial public offer, initial public offer. They would just take the money and run, and that would be it. And so, to some extent, Enron was a company which was also betting on the future of the internet, also had a wrong picture about actually not how big it would become, but how fast it would become that way. Another important aspect to mention just when you start is the following. There was, as opposed to what happened now in the year from the year 2009 to now, as a reaction to the crisis, to the current crisis, there was immediate response in 2002 to what happened to Enron, and there were changes. And there were major changes, and the major changes were part of what is called the Sarbanes-Oxley Act, which is a set of laws. And the aspect which is relevant about Enron is the following. Mr. Jeffrey Skilling had been the CEO of Enron for quite a while, in the year 2000 and 2001, and he had retired as a CEO just before the crisis started, to such extent that some people said, well, he's retired as CEO because he saw the clouds accumulating. He knew that it was time to get out. The fact that he had also actually acted already as a CEO in a period when he was not, when there was Kenneth Lay, who was the head of the company before, who was still in charge officially as a CEO, but Skilling was already working in that capacity. And when Skilling, after the fall of Enron, is called first to testify in front of a Congressional Financial Committee in the United States, and then later on when he's tried, and the fact is that Mr. Skilling is still in jail for what he has done at that time, which some people may say that what he did actually might be regarded as relatively minor to what has been done recently by some other people in the financial industry. But it would be a different discussion. But his line of defense, either when he was just simply asked to testify at a hearing of the Congress, and later on when he was actually tried, his line of defense was always the same. What do I know? I'm not an accountant. He was rejecting the whole responsibility of what had happened to Arthur Andersen, which was the audit firm. And I'll say a lot more about Arthur Andersen, who was the audit firm of Enron. So anytime he was asked about the figures, about business plans, about projections, about forecasts, he said, well, what do I know? I'm not an accountant. The Sarbanes-Oxley Act prevented that from being the case in the future. In the Act, it's written that the CEO of a company is actually personally responsible for the validity of the figures which are shown quarterly and annually as being the balance of the company. This way of escaping a discussion became impossible. There was, from then on, a responsibility from the CEO to say that the figures which are presented have his own responsibility or her own responsibility associated to them. So that aspect of the crisis, of the lessons we can draw from Enron were drawn, and they were it became part of the Sarbanes-Oxley Act, which was really focused on the notion of governance, of the heads, the executives of a company not being able just to dismiss their own responsibility in the way that the figures, the accounting figures are presented for the company. The fact is that when you look at Enron, what was particularly obvious, and to some extent that company was a Texan company based in Houston. I had the opportunity in my life to work for a hedge fund in Houston, and to some extent the mentality of Enron was, I would say, a bit of a cultural thing locally. It is very much, I would say, a Texan type of attitude that was displayed by the company. Very, very arrogant, very little respect for people that you regard as not being like yourself. And for a company like that, the first people who are not like yourself and that you should not have much respect for are the government and the regulator. Anybody who's working for Enron below a certain level, and that level was very clear in the company because from that threshold down, you had no right to stock options, and from the level up, you were entitled to stock options. And the company was very generous in that respect. 60% of the employees of Enron were allocated stock options, and I will say a bit more later why it was so generous. It actually made it possible for a company not to pay any tax, because it is the allocation of stock options is actually subsidized by the government. But I'll come back to that later on, because why should a company be subsidized for stock options while there's no cost at all for the company for issuing them? The company, therefore, was, I would say, very, very brash. The culture, it was one of the companies who introduced that rule, which has become very common later on in American companies. I mean, in the period from 2001, and very much common on Wall Street, to have fear as part of the way of dealing with personnel. There is a rule that every quarter, 5% of the personnel is actually disposed of. And that introduced a real climate of fear in a company. It reduces by much, there's an article recently that shows that it reduces by much the critical spirit within a company. If you know that you could be put in the 5% that will go next time, well, you will be less inclined to criticize what's being done by your supervisor, who are the people who will actually decide if you stay or you're not. There was a transition time, like you would be put on probation for 6 months if you were under 5%, so it was not automatic. But it did introduce, and a lot of articles were written with interviews of employees. It was clear that it produced a climate where you would not question on the whole much the decisions of anybody above you in the hierarchy, because you feared that it would push you in the 5% category. But there were other aspects in the way that the company was run that was displaying the same kind of traits, of characteristics or traits. One was the way, for example, that the company created a energy plant linked to a dam, hydroelectric power in Dabhol in India. And I'm talking now the period like 1999, 2000, a few years before the downfall of Enron. Enron was very much on the radar of human rights organization because Enron had hired in Dabhol security firms to be a kind of mercenary police who turned out to have a terrible record. The way that it brutalized the population, it was threatening people, local people who would criticize the way that the plant was built, the way that land was expropriated, and so on. There were reports at the time. I think I have one at home. By I think it's got Human Rights Watch. Yes, an organized ONG. Human Rights Watch, who wrote a little book about the way that Enron was behaving in India, and that was 3 to 2 years before the company got into trouble. It's also well known that that Enron got in real trouble for the way it was dealing with the Californian energy supply. This is something that's well known. I mean, it's been discussed a lot in different articles because the tricks they use in order to cheat on that deal with California, they used vocabulary from Star Wars. And so there's there's a Death Star, and, a number of schemes they were using. And they were playing essentially on the following. As you know, if only because you've seen American films, you know that the police goes after some escapee, and they reach the state border, and the police has to go back because you can't go further. And there's that line on the road, usually in a desert, and there the fugitive goes, and the police cars are stopping because they go into a different state. And that was the case, and to some extent still the case, for instance, for dealing with energy. California is surrounded by a number of other states, by Oregon, Arizona, I'll try not to make any mistakes there, Nevada, and I think that's about it. And the people who would be running the grid for California would not know anything about what is going on in Arizona, on Oregon, and so on, even if electricity is actually crossing the border between the companies. And so Enron, who was creating a proper derivative market on energy, on all sources of energy. It even created derivatives on weather that agriculturalists could turn to in order to protect themselves against accidents of a meteorological nature. Enron had access to all the information, and it produced deliberate shortages of electricity by sending false information. It was deciding in a strategic way to put some firms on maintenance at times when they thought there could be a shortage. They used a number of tricks of that particular type in order to make the life extremely difficult for California, where the price for energy would be just defined by supposed supply and demand, and which in times of high demand, which would be typically the months of July and August, because the main demand would be at that time in terms of air conditioning, which is necessary in a large part of the state in these months where the temperature can reach easily 35, 36 degrees in some part of state. Enron played on that. And if you look at the emails that were published later on, you could see how little respect the people from Enron had for the people they were delivering the money to. So that the particular view that the client is king, as you know, that view was already coming down under the onslaught, under the attacks of Milton Friedman and Hayek, where that the theory that the client or I would say the employee of a company would come first had been debunked and removed and replaced by the theory that only the shareholder, the stockholder, the company has only to report to the stakeholder, not the stakeholder, the stockholder and the shareholder, and only work in that particular respect. The company, in terms of arrogance, the company would go even further. It would, if some part of the legislation was inconvenient, and this has unfortunately become very common, it would just put a sufficient amount of money for lobbying in order to have that part of legislation being removed. The most blatant case for Enron that Madam Wendy Graham was at the head of the CFTC. CFTC is the Commodities Future Trading Commission, which regulates precisely what it says, the dealing of future contracts on commodities. And she was at the head of that commission, a governmental commission for quite a while. She made sure that during the period of her term that there would be no regulation of derivatives on energy. And as you know, that was one of the main businesses of Enron. And as soon as she had assured that, she resigned and she was appointed to the board of Enron. It's one of the great historical cases of regulator capture. One of the special features of Enron was the very close relationship it had developed with the firm that was its auditor. There was the auditor was Arthur Andersen. There were people that were working permanently within the Enron building. They were part of Arthur Andersen, but they were there for forever, as far as people could determine. And that was also, it turned out that was something also that the Sarbanes-Oxley Sarbanes-Oxley Act changed, is that it imposed rotation of auditors within company. There the lesson had been drawn, another example of a lesson being drawn from the case of Enron. The people were working at Arthur Andersen in other parts of the I would say who were not involved with Enron, said in interviews that they regarded the Arthur Andersen Enron people as being a real subculture in its own. What did Arthur Andersen work on? It worked on designing particular mechanism to deal with specific issues. The amounts of money that were paid by Enron to its auditor were unusual. It paid very large amounts of money. I haven't written down the figure here, but I remember 55 million in one particular year just for Enron, that, as I said, was probably at number 287 in terms of the size of the company in the United States. 55 million just to pay the auditor. But the auditor was actually doing a lot of work for the company. It was probably worth paying that amount. The phrase that were going on saying Enron and Arthur Andersen are brothers in arms And as you know, Arthur Andersen vanished, disappeared, was disbanded as a company as a result of the fall of Enron. Arthur Andersen devised a lot of creative accounting for the purpose of writing the books of Enron. What would you do? You would essentially try to play some rules. You would try to make some arbitrage, as people say, find something which is more expensive and something less expensive and go for the less expensive. Some loopholes, some contradictions within the law. I'll give you an example. Arthur Andersen developed for Enron an instrument called MIPS, which is a type of preferred shares of the company. And it devised it in some way, and in one way, that it would be regarded by the IRS. The IRS is the Internal Revenue System in the United States. It's the body that deals with tax in the United States. And the MIPS was written in such way that it could be regarded as debt as far as the IRS was concerned, meaning that it would have, interest would be tax deductible. And at the same time, the instrument was written in such a way that it would, for accounting purposes, it would be regarded as equity. So you were playing on two, I would say, you were taking advantage of two things at the same time, although, of course, the product is of one nature, and either it was that or it was equity. But the rules were written in such way, in accounting rules and in the IRS rules, such that you could actually play one or the other. What would you do typically? You would take a very simple type of transaction and you would dismantle it, make it such that you could actually disentangle it, make it a combination of things that would, different elements that could gain some fiscal advantage or some legal advantage in one way. I'll give you one. What do you say?
No, I'm just following the argument.
Yes, I'll give you one example, which is called as a purchase. You buy something, but you transform it into a synthetic lease. And what is a synthetic lease? In the case of Enron, it had to buy a building for its headquarters and where a number of employees would work. You create a synthetic lease. You create a special purpose vehicle, which is a separate entity which will not appear in your balance. It will be off balance item. You will sell the building to the SPV. You would lease the building from the SPV, and you would benefit by being able to deduct from your tax income the interest flows that you pay to your SPV, which is actually nothing but your creature. The only condition that needs to be respected in that respect is that 3% at least of the financing of the SPV should come from an outside source. That seems like a little detail of not much importance, but that's actually what will bring down effectively Enron at some point. Another aspect of what brought down Enron, and I wouldn't say, and when you'll hear what I say, you'll realize that that's not very special at all to that company. It's very much, I would say, one of the common features of all type of commercial ventures. It is to having an over-optimistic view of the future and the capacity of the company to survive. I was working at Countrywide, the company that brought down the subprime at the time it came down. For people who haven't heard the story, I had made sure. I went for interviews specifically to be there at that particular time. But when the company realized that it was over, that the subprime prices would take everybody away, Mr. Angelo Musillo, our CEO, came to different parts of the company, and he was speaking to me closer than Maxim is there, and he said, "This is wonderful because our company is so good that in this turmoil we'll manage to make our market share come up. We'll be maybe the only survivor, but we'll be the survivor." And he said that about, I would say, 6 months before the company vanished. And I'm sure that he believed it. I'm sure that he was genuine. He believed really what he was saying at that time. And to some extent, we'll say a lot of success derives actually from that over-optimism, because it gives wings. It makes you fly. And it may give you actually the energy and the determination to go through some obstacles that would otherwise bring you down. How did that optimism show in the actual story of Enron? As I said, in the period of the dot-com bubble, the value of the share was going up and up. A company is not, at least, I don't know if it's true for over the whole world, but in the United States, in any case, a company cannot speculate on its own stock. It cannot make benefit from the fact that the value of its share, of its stock, is going up. But is it forbidden that you speculate on a derivative of which the value of your company through the price of stocks is resting? This is not in the law, and therefore, at least until it gets forbidden, there was no obstacle of doing so. And Enron did that. It definitely did that. It created some of these special purpose vehicles, also were called, in their vocabulary, they call that the partnerships. And they subsidized, and the funds, the actual financing of some of these SPVs, from one that was called rhythms. It was warrants, which are actually the same as a call option, meaning that its value is going up when the value of the share is going up. A special purpose vehicle whose financing is linked to the price of the share, it's very easy to understand that it will go down and it will be bankrupt as soon as the value of the share comes down. Other companies did things very, very similar. The French company Vivendi financed its all setting up a stock option approach. It financed it entirely with puts on its stock. A put is a option, the value of which goes up when things when the price is coming down. And Vivendi bet also on the fact that, of course, the value of the company expressed by its share would never actually be hit. And houses of cards were built in that particular way, where you rely on the fact that things will necessarily go well and that they will never go wrong. An example I think I gave in one previous lecture of that in the case of Enron was the following. The company would do a contract with you and would say, if you, my client, would actually lose money if our credit rating would be downgraded, we'll come up with the cash and we'll pay the difference of, we would reimburse you for the loss you would actually incur in case of a downgrading of the company. Now, when does a company get downgraded in terms of its credit? Of course, when the credit is impaired, meaning when the company is in trouble. Is the time when the company is impaired? Is it the company where it has, how would I say, spare cash that it can pay to its client? Of course not, by definition, because that's the time when they are in trouble, and that's why they've been downgraded. So that means, again, that people knew that, but they thought it will never happen, and that's why they could actually do it. Another example, I think I've made an allusion to that in the way that the asset-backed securities or the mortgage-backed securities, which are the actual securities which brought down the whole business of subprime, these were actually they had a lot of what is called credit enhancement. There were mechanisms inside to prevent that things would go wrong. There were valves in the system. There were reserves they would made, and actually these reserves would actually be used if some people defaulted among the borrowers, and therefore there would be, I would say, a self-repairing mechanism. When the crisis started, we realized that these triggers that would make the money flow back from the reserves, that these actually had not been set within the system. They were written in the prospectus to the clients. You had these 300, 400 pages documents telling you how it would never come down because there were mechanisms inside them. But in truth, these mechanisms had not been set up. And why? Again, because people said it will never go so wrong that this would ever have to be used. When it had to be used, it was simply not there. It was missing. Another example of over-optimism that leads to a terrible situation later down. This view may actually suggest that if the executives of the company were so confident that nothing go wrong, that it was actually their inner feeling and that it was just naivety on their part that it didn't work out in that way. But at the same time, when you look at what happened, some mechanisms were there. They had been put deliberately, that if things went wrong, that the money that these people had made would actually be protected against anything that would happen. And that was something that made these people on the boards of the congressional and senatorial committees that had these people come and to hearings and tell what happened. That what drove them so mad in accusing these people, and that's probably one of the reasons why Mr. Skilling is still in jail. Mr. Kenneth Lay got a heart attack and died before he would go to jail. Mr. Fasto, who was the CFO, Chief Financial Officer, just came out of jail 6 months ago or so. And he's making a lot of money on tour, going to universities and explaining what he did wrong at the time. But anyway, at these hearings, you have some senators and Congress people who were explaining the situation. They said, listen, the people in your company have lost everything, but Mr. So-and-so, the $56 million that you got as a bonus on this particular day is protected by our laws against any clawback, that money would come back to the community. If you look now at the discussions around bonuses, there are measures which are proposed now as clawback, that if anything goes wrong, well, that money would not be kept by the people who were the culprits of these in these particular situations. But the examples were blatant at that time of Enron. As you know, pension schemes in the United States are essentially private. It's not run by either the state or by the federal government. It is a scheme that you set together, and usually with the very help of your company. The problem in the United States is that companies are allowed to put a very important part of the money they're putting into your account as under the shape of shares in their company, meaning if that shares come down, your pension fund, your retirement money may disappear altogether. In the case of Enron, where the value of the stock dropped from 100 something in a very short time, in these 46 days, dropped to cents, under $1, the people who had a large part of their retirement money under the form of shares of Enron lost it all. There are figures that were cited by some of these senators. I think I wrote down some, but I'm not sure that it's entirely relevant. It was a case of a man who had on paper a retirement plan that amounted to $1.6 million, turned out to have something that was left was $13,000. Of course, you are allowed by law to change the allocation. You can ask, for instance, that only obligations, only treasury bonds, for instance, would be put in your account instead of the shares of the company. But then again, you would think that it's part of the spirit of being a company to be extremely confident in its future, and most of the people had not shifted all the amount of shares of the company, of stocks of the company, and their retirement plan. What is worse is that what happened is that as these plans, as they called, are run, are actually directed and managed by private companies, the contributor, in this case Enron, may decide to switch companies. That they would, have asked one particular insurance company to deal with the Enron retirement plan, and then they're unhappy about the returns, and they turn to another one. And it happened that in the time during these 46 days of the fall of Enron, there was a shift that had been programmed earlier on, but it led to a 6-week freeze in terms of the possibility for anyone who had one of these retirement plans to do any shift. So it means that the employees who saw the money coming, the amount of money left in their account disappear with the drop of the price of the share of Enron, could not do anything at all because there was that 6 weeks freeze during which they could not actually act on the composition of their portfolio in their retirement plan. Nothing of the type was the case for the executives who had large amounts of shares or even stock options, and they managed during that period to protect themselves by selling some of their shares early in the period. Some, of course, knew also about the difficult times for the company and did insider trading by selling their shares very early on, as soon as they understood that there was there's a problem of that type. All the provisions which exist in terms of the executives shows that however confident they may show themselves to have been in the future of the companies, there were, as the congressional people said, there were safety boats for the first class. The comparison with the Titanic was very much used in the accusation that left for Enron. They said there's a third class for which there's no rescue boats at all, and but they were first class. There were safety boats. How would I say? Rescue boats for the people in the first class. They were protected against any particular risk. And I refer to that company, Countrywide, and I mentioned that speech made by Mozilla to different parts of the company, being so confident. But it happened that at some point that they realized that it was coming down, and that these 2 final months where I worked for them, the executives disappeared. We had meetings that were planned. Nobody higher up would show up. We were supposed to get directives and instructions about what to do. Nothing happened at all. There was, and the talk between us, middle rank to higher up, but not top executives, the way we were talking about the disappearance, the fact that our chiefs were not there anymore, we had developed that image. We said they're building the raft, and that's very much the same image as the one for Enron. They were working hard at trying to protect whatever asset they had in the company and finding a way to protect them. They were, I mean, part of what they were doing were spreading positive rumors. That was a way of protecting against downfall. So there is that strange mix, I would say, of being over-optimistic, saying everything will go fine, etc., but at the same time, for part, the top part, the upper part of the company to have to be ready in case of accident. The golden parachute is very much of that nature. And as you may know, last weekend in Switzerland, there was one of these votations, there was one of these referendums that was actually won, the one that forbids golden parachute, actually won with a very comfortable majority. 68% of the Swiss people across all cantons voted in favor of that measure, showing how much there is a frustration among the population about that particular issue, that protection of the top against the consequences of the errors they can make. And as you know, it's difficult for anything to have a majority like 68%. For some reason, on issues which are human, you often come to 49 to 51, things that you have very much half of the population in favor of some type of measure, and about half against it. Among these measures that were very protective of the company, there's the in order to avoid some taxation on some of the income, some of the revenue you get from the company, you may put it in a account which is deferred payments, and you typically defer the payment until you're retired, and in which case you usually fall into a lower income tax bracket, and making that money will actually be less taxed than it would be if it were paid right in front. On these deferred benefits for executives, the company was actually paying 12% to the people who were deferred some of the money. So not only would they benefit from a better imposition later on, but at the same time they were getting 12% accrued per year on their accounts. A number of advantages of that type became mentioned, not only for Enron at the time, but also for some of the other companies who had fallen in the with the dot-com collapse of the stock market. Mr. Fasto within the Enron company created some partnerships that were useful at the time when there were some losses, and he got an upfront bonus of $50 million. Mr. Ebbers, who was the head of the WorldCom company, he had a line of credit on the account of the company of $408 million. In the company called Adelphia, the Regas family, which was the family of the founder, had borrowed $1 billion from the company, and had actually invested that $1 billion into shares of the company. These things also became forbidden by the Sarbanes-Oxley Act. Executives were not allowed anymore to get loans from their own company, in particular for schemes of that particular time to reinvest it in to boost the price of the share. It needs to be said that a number of these outrageous behavior were really facilitated and even encouraged by some changes in the accounting rules. A number of things changed which made that particularly possible, that to some extent the executives of the company could actually plunder it while it was actually running. As soon as the mark-to-market approach was introduced by some changes in the FASB rules, the Federal Accounting Standard Board, as soon as that was done, companies could actually give people bonuses made out of on money that was simply due to accounting tricks, I would say. Why was that possible? Mark to market, you could actually then upfront put a lot of benefit that would come in the future. You would discount it by some percentage to get to actual value, present value, but at the same time the amounts could be regarded as very large. When the Double project, I mentioned already Double because they used, Enron used a security firm which was particularly brutal around the construction of the energy plant. But when the contract was signed, the money that was supposed to be made by that, developing that energy plant was such that two of the people who had been in charge within Enron of that particular deal, Ms. Rebecca Mark, received $54 million bonus, and Mr. Joe Sutton a $42 million bonus. And this was 1993. The fact is that it turned out that the Double energy plant never worked. No money among that these bonuses, which were supposed to be very small amount of the whole money would be made. Actually, no money was made at all. It needs to be said, now I said the behavior were encouraged by the accounting rules. It needs also to be said that if the accounting rules were regarded as proper, it is because of some quote-unquote progress in economic theory which had made possible, which had justified the way that the accounting rules were done in that particular way. Economic theory had just determined in the years before that you could actually, that the theory, the hypothesis of rational expectations was true. Rational expectation means essentially that with perfect transparency of information, complete information, it is possible to know now anything that will happen in the future. Now, I've already alluded to the fact that no physical theory makes it actually believable, but the fact that in physics, as a field, you regard it as being total nonsense has not prevented economic theory to put it as a major principle of its, how would I say, one of the postulates within the its own working. And if it's the case that with appropriate, complete information, you know everything about the future, there is nothing that would prevent you from sharing already some of the money that will come. The counterexample is the one I just made. You give people bonuses in tens of millions, and the plant actually never works. All the information was probably correct about what should have happened, but the fact is it did not happen. And that brings us back to one of the points made last time when we talk about risk. There is risk you can assess through probability theory, through actuarial approach, but there's some risk that may be of a different nature, which is not taken into account and which actually will ruin all your whatever will happen. Now, the fact is for a company of Enron, it is not irrelevant that these bonuses are paid and that the money will never come in. It is impacting, of course, their results. Between 1996 and 2000, which is the last time they paid, they were supposed to pay tax because for 2001 they never were asked to do so because they came to their end in December of 2001. But for the 5 years before, the company never paid any tax. It got major tax deductions for precisely in that 401k retirement plan of their employees for having put a lot of shares in that in these accounts, and for having done that, they got deductions, tax deductions. They received also a lot, and I already alluded to that, but I said I would come back to it with a bit more detail. They got a lot of tax deductions also for assigning so many stock options to their employees, to such an extent that they got below the level where they would have paid any income tax at all. The reason why stock options is regarded as being tax deductible is because it is remuneration. It is money that will be given to employees. But where does the money from the stock options come from? You assign some options on stock on one particular day. and it should be on the value of the stock or the share on the day that the stock options is allocated to you. I insist to that because 80% of the Dow Jones companies in the United States, 80% of them, the top companies, were actually caught red-handed for having predated the allocation of options. The stock options allows you to sell at a particular price the shares of the company the day that you decide to exert your stock options. So let's say you're given a stock option on a day where the stock of the company is $25 or 25 euros. The stock goes up, it goes to 28. At some point, you decide to exert your stock options over, let's say, 10,000 stock options. 10,000, you can buy what's worth 28. You can buy it from your company at 25. You can decide, and that's what people usually do, resell it right away, and you make $3 multiplied by 10,000, you're making $30,000 right away. What is the cost to the company for that? Nothing at all, nothing at all, because it is the market that's made the price of the share go up, and there's no particular input of the company apart from the manipulation that the company has done on the stock, on the value of the stock all over. But because it's a remuneration, it allows tax deductibility. Who decides these measures? I mean, the person who decides that measure either doesn't understand that in truth there is no cost for the company, or that person who decides that it's real in bad faith. It knows that it's not the case, that it doesn't impact the revenue of the company, its earnings, but it still decides that it will have tax deductibility for that. The day that the company folded, that it went bankrupt in the days following, $5 million were taken from the remaining capital of the company. It was set apart in order to give employees, to give them I tried to find the expression. Anyway, I don't find it, but usually the employees in the United States, and it applies in a lot of other places, if you are fired by the company, I mean, for no fault, if it's economic reason that leads you to being jobless, there is some amount being paid for you. There is a certain cash amount, the phrase of which escapes me. Anyway, for the whole company, $5 million were set aside that ended up giving each employee 4,500 separation, okay, that's a word, a separation bonus. People got in the company separation bonuses for an amount of $4,500. $5 million had been devoted for that. On the same day, $5 million were set apart to pay one executive that amount if that executive promised to stay for the company for at least 90 days to help with the bankruptcy. And that's linked to the Chapter 11 bankruptcy law in the United States, which employees which are regarded as essential for the company will be compensated if they stay with the company for at least 90 days. But of course, I would say the press, everybody around the Enron affair, put these two figures in parallel, $5 million for all the employees, leading to $4,500 for each of them, and $5 million for one executive who'd shown that he could not run properly a company. That was quite blatant, just to stay for 90 days. I've made an allusion to the fact that even if you look at all these different aspects, accounting, what's possible in order to put the law on your side, trickery because of asymmetry in information, like Enron has a lot of more information on the energy market than has a particular regulator for one American state, and so on. All these elements show all these things that come up together in order to bring that company to be on the brink of actually coming down at a particular time if any difficulty actually happens. What was the difficulty? I refer to the fact that an SPV, a special purpose vehicle, in which you can put off balance sheet a number of the difficult, dicey things that you have, in order for that SPV to exist, to have a proper existence, to be legal, you need to have 3% coming out of another financial source. And there were people who were coming up with these 3%. There were the Friends of Enron. The Friends of Enron would be asked to put some of these 3% in this special purpose vehicle in order it would not appear on the balance sheet of Enron. These people also use in other circumstances. At the end of every quarter, in order to improve the cash flow, or the cash flow as being publicized, Friends of Enron would be asked for a period of about 2 weeks to 3 weeks to come up with some money that would boost the figures for the time just before the release of the reports, and they would be paid 15% on the money which would be lent in that particular way. So these Friends of Enron could make quite a bit of money in different ways. What happened is that in August of 2001, Arthur Andersen realized that in one of these special purpose vehicles, the law had been breached. There was actually not really 3% coming from an outside source. Why was that? Is that because the Barclays, which had lent some money to Enron, had actually asked Enron to put some collateral as being the guarantee for obtaining that loan. And so when you did all the calculations, you realized that the 3% put by Barclays were not actually 3% because Enron had put some of that money under the form of collateral. Arthur Andersen released that report in August of 2001, saying that the accounting of that particular special purpose vehicle had to be consolidated with the results of Enron, and that brought a $1.5 billion loss within the company. That triggered that 46 days period within which downgrading by the rating agencies led to triggering some of these measures had been set that the company would compensate people who would be impacted by such a downgrading. The company, of course, was not in a position to do so. There were some perverse effects that were for the first time realized in the operation of the rating agencies, which was the following, and I think I mentioned that last week, that the fact that one of the rating agency would downgrade the company would have such effect on some economic factors that it was impossible for another rating agency not to downgrade it by the same number of notches, but by more, assessing it lower than the other one, which would force the first one to take that as an event also to take into account, and that there would be a downward spiral in terms of the credit rating. When Skilling was asked about what happened exactly in that period, he called it a run on the bank. He says it's exactly the same thing, that a run on the bank at that particular time. Why? Because, of course, there are clauses linked to the loans that you've obtained from other people, and a downgrading is one clause that would suggest that actually they would ask like a margin call, that the collateral they offer, they put as a guarantee would be upped, and so on, leading to that actually a total collapse within a very short period. Now, what had rendered the company more fragile to these events was that it had become called an asset-light company. It started as a company who had most of its assets in plain, solid things, in pipelines. They had a lot of money in the very beginning in pipelines, where the actual oil, gas would be transferred, communicated between one place to another. In the 1970s, the McKinsey Bureau developed two notions that were new and that had a lot of consequences, and of which Enron turned out to be the actual victim. They invented the stock options, and I've already shown up, all the difficulties and how what the fragility is linked to the stock options, and had developed the notion of asset-light company, meaning that a company should have as little as possible assets that would be plain. It was the beginning of the notion of information and of knowledge, and the company should be essentially knowledge-based and information-based rather than being asset-based. But the image that comes to me in that respect is the following. It used to be that you said that a baby, a small child, should be chubby, that it should have big, fat cheek, and so on. And later on, from the 1970s, you've said, no, a baby that's healthy should be a baby that's lean, that's like a normal human being, and not be a fat baby. And why that image comes to me is because I've worked in Africa at some point where dysentery among little children is very common. And if your baby is not chubby before it gets the dysentery, it just simply dies. If it's lean and looking really nice and not being fat, its survival rate is very, very low. And that's what happened also with Enron. It became so asset-light that when money had to be found in an emergency in order to pay some of the things that need to be paid, it had nothing to sell, and therefore it could not survive from there. It was also a victim of things that had nothing to do per se. The fact that in the United States, dividends from a company are more highly taxed than gains on capital had a disastrous effect on that. If the company had to pay dividends, and knowing that the stockholders would rely on that, essentially, to assessing the health of the company, it couldn't have divided as easily money to come and divided it into bonus. It would have to have that money in order to pay it as dividends. But the shareholders were more interested in the gains of capital because it was less taxed. And the gains of capital, what can you do to improve the gains of capital? The only thing you need to do was just try to lift the value of the stock of the share. And that, of course, was an incentive to this behavior we've seen, where the company would, for instance, borrow money just to make it look chubby before the results need to be published, borrow it at 15% with a 15% interest rate from some friends, and make it look better than it was. You see that simple fact that dividends are more highly taxed than capital gains, for some reason which is probably historical, is probably not somebody who would devise that for a particular purpose, but this government said, well, we're going to raise the tax on this, and the other one said we're going to lower it on that, and you end up in a situation where there's a perverse incentive that the dividend, which is actually the reflection from the earnings of the company, it's a share on what the money that the company has made. It's plain, it's true, it is solid, that it would be disadvantaged in the view of the very volatile value of the share, which can be just, as you know, being determined by some bubble, by some speculative moves done by this or that party, by the crowd effect, that suddenly people think that it will go on forever, and so on. Among the other things which had made the companies extremely fragile were a number of deals that had never worked. They went into a venture on British gas in Britain that didn't work. They invested a lot of money in a fuel additive that turned out not to work. They bought a company, Azurix, in Britain, the water company, and were unable to run it properly. I mentioned Dabol, that never took off. There was one particular deal that would have been really, really profitable from the company, was a sheikh from Abu Dhabi, who turned out to have to be operated in emergency just before the deal was actually signed, and that the whole thing fell through, which could have saved Enron. I mentioned broadband, where they had made a very bold move into the internet, but that was premature. There was too much capacity at that particular time in order to I mean, the capacity was too big compared to what the market would absorb. So to conclude, we have a large number of elements being present there to explain what went wrong with the company. A number of objective things which I would say were part of the culture that was shared by everyone. A number of discrepancies that have probably some historical reasons, like the different taxation of dividends and of capital gains. The attitude, the very brash attitude of the executives. Also the fact that the laws allow a company, as we saw, to protect the assets of the executives, but doesn't protect the employees or the lower ranks employees in the same way. So a large number of elements showing, I would say underline some of the points that I make sometimes, that to some extent what impacts us here in a negative way may be linked essentially to complexity having developed, that we don't, by having allowed things to be very complex, we cannot master anymore the interactions between the different elements which are there. To finish, as I said, I mean, as you realize, I'm quite critical. I mean, I look at all the aspects and I put them together. But at the same time, Mr. Skilling, who's somebody who probably I would never make as a friend, I don't understand why that person is still in jail right now, honestly. He worked for his company. He made a number of, I would say, strategic errors. He didn't discourage greed. But at the same time, I wouldn't say that he did anything criminal of a nature that justifies that, especially compared to a number of people that we've heard recently being interviewed by the same congressional and senatorial bodies in the United States. What he did, I think, is less serious than what a large number of people that we've heard recently, and who are just most of the time just allowed to keep on running their business at the head of the companies that they are running. I think that's an aspect we should really seriously think about in terms of bringing some more of an ethical approach within business. I think I just ran out of time, but if it is one or two questions, I would definitely answer to them with pleasure. Yes?
The question with respect to there are a number of elements which have led to the let's say the Enron scandal, its morality, its complexity. One of the elements who played in favor, and you mentioned, Professor, was, let's say, the change in accounting policy.
Yes.
They changed in FASB.
Right.
A rule where we went from a prudent accounting approach to a fair value, or an approach where you can, let's say, discount the future profits.
Yes. Yeah.
We see the same thing in IAS of IFRS, the accounting standard that we are adopting now.
Yes.
And if you see that one of those elements is really endangering, and maybe together with derivatives and a kind of theoretical market, endangering our future. I don't understand why we are still, it's 10 years after Enron, we are still pursuing in that respect. So it's still fair value, it's still the same funny values.
Yes. Yeah, I totally agree. I think I mentioned at some point a report that was made in 2009 about what needed to be, it was a report from a French study group, what needed to be done. We were just 3 months after the collapse of the money markets as a consequence of the bankruptcy of Lehman Brothers, and that bureau made a very good report, I think, which could still be read with a lot of interest, and they put a, possible strategies towards how to solve the problems. And they, in addition to that, they assigned authorities, I mean intellectual authorities, the names of these people to the different possible strategies that could be used. I was flattered that my name was mentioned as associated to a particular approach. But one of the strategies they had defined was to try to reconstruct the financial system exactly in the same state as it was before the crisis occurred. And to that particular option, that particular strategy, they could not find any authority in the economic circles that would defend that view. The fact that the approach has been used, as you know, is that one. That's the one that's been used in the United States, that has been used in Europe. And the question can be raised of why did it happen that that the approaches which were suggested by, let's say, the experts were totally ignored. And it's the same as in what you mentioned. I think in that case what is mentioned is only the vested interest that people that think by not touching to anything or trying to reconstruct exactly as it was, I was personally benefiting from that, so let's go back to that. And I think we see that in the discussions in at a number of what comes in my mind is the discussion at the SEC in the United States, Securities Exchange Commission, where they have been thinking and trying to come up with measures to prevent the collapse of the money markets, which was the trigger of the in that third week of September 2008 that led to the collapse of the whole system. And they've come up, it was in June this year, they came up with the measures that should be taken in order to prevent any of that of these events occurring again. And there was one member of the commission who was known to have very strong ties with the industry, with the sector, with how would I say, the business people, and he put effectively his veto to any of the measures being taken. That, as you realize, I mean, 2009 to 2012, June 2012, 3 years of work, input into finding the way to prevent that, and just the power balance between the parties, the financial sector as such, and the regulators being in favor of the sector and not of the regulator, and preventing the measures from being taken. Now, I understand that at the government level, there's some initiative from, I think, as the Treasury to try to circumvent that now. But it shouldn't be the case. I mean, the SEC was the place where the measures were taken and where it should have been implemented, and just the power balance. The issue there is that the people who've made mistakes, terrible mistakes, showing that to some extent there was some control of the situation that they did not have, are still regarded as the experts and still the people who are deciding what will actually take place. Yes?
Very interesting.
Thank you.
Interesting, especially about the Enron case. As myself, I've been involved as credit insurer.
All right.
In the past, and I've looked at this case, and of course, many investors and insurers have lost a lot of money.
Right.
But I was wondering, you didn't mention really the role of the rating agencies.
Of the?
Rating agencies.
Yes.
Of course, you are speaking about the auditors, Enrons.
Yes, yeah. Yeah, yeah.
But rating agencies, which normally, and we see still now in the bank crisis, that have also played a very important role on derivatives and on taxation side.
Yes.
At that moment, did you look at their behavior and their role in this? Because they had given rating and people were confident that it was a good rating, that they could invest in the market. And of course, there was a success story behind, and everybody became then confident.
Yes.
And rely on, okay, they have a good rating, so we can be confident on it. I'm a little bit more concerned about their behavior and what they have done apart from.
Yes, yeah. Well, if you follow my whole course, you know that I meant there's hardly any lecture where I don't mention some aspect of the rating agencies, and I've been honored that the French Senate, when it made an investigation about rating agencies, asked me as one of the persons to come and talk about. And in the coming weeks, it will be the French House of Parliament, the l'Assemblée nationale, that will have a deposition from me on tax shelters. So it is an aspect that I try to cover because, as I said, the rating agencies, I've been talking quite a bit about them in different aspects over the weeks. So in this particular case, I've only mentioned the downward spiral, but indeed, it's not that it's an issue that I'm not covering or not considering is really important. But because I touch it up, I touch it on according to the perspective of my particular lecture. In this case, I thought it was relatively minor compared to other factors, especially in the light that I mentioned rating agencies quite often. But I was not trying at all to try to minimize what is their importance is in that particular process. The quality of the models is very much in that they use is very much in an issue. And I've been dealing with that during my career when I was a model validator in American banks. And to me, the most important factor is that because of the commercial competition between them, that they've allowed themselves to rate products for which there are no known methods for assessing the risk.
Because when you look at that moment to their balance sheet and the quality of their assets,
yes, yeah.
Nobody.
Yes, but in most of the cases, and you know, there will be an issue because S&P has been really accused by the American government. Most of the cases, I would think that their defense line is that the method they were using, although they're inaccurate, are those that were recommended by economic theory and that were supported by Nobel Prizes in economy. And that would definitely, if I were them, be my line of defense, saying, well, this was supposed the best minds that had defined that was a way of looking at this particular aspect. Sometimes there are errors that, you know, the Lee copula, Mr. Lee allowed to admitted that there was an error in the approach altogether, but that's pretty rare. Otherwise, this is all based on, I made a reference to rational expectations. Rational expectation is the admitted economic theory that justifies mark-to-market pricing. Thank you very much. Thank you.